Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. The US dollar gold price, it actually has been holding up very, very well. It's been rallying quite a bit lately. It's almost at 2,900 at $2,843. I think it was a little bit higher than that earlier in the day today when we're recording this interview on Tuesday, February 4th, 2025. Our guest today, he publishes, the editor and publisher of the longest running gold investment newsletter. He's also the CEO of the famous New Orleans Investment Conference that has a lot of big name guests that you listen to all over financial YouTube and see on business television. Brien Lundin, thank you for joining me.
Great to be with you, Jason. How are you?
Doing all right. Happy New Year to our listeners out there. Happy Chinese New Year, since we have that. And that's a segue into what do you think is driving this relative strength in the gold price, considering the dollar strength, and people can go, if they wanted to, go and get a relatively high yield on government bonds. Are you surprised that the US dollar gold price, there's relative strength considering a relatively strong dollar and the dollar index around 110, and that people can, there's bond alternatives?
Yeah, I don't think I'm really not surprised. What we're seeing right now is basically a continuation of what we saw last year since about mid to late February of last year. So, frankly, just we're about to celebrate the 1 year anniversary of this new gold bull market. And over that period, we've seen a number of times when the correlation between the dollar index and gold has been actually a positive correlation, and the correlation between treasury yields and gold has been positive. So over that time frame, this nearly 1 year period, we've seen times where the dollar has been strong and gold has been rising. We've seen times when the dollar has been weak and gold has been rising. We've seen times when treasury yields were rising and gold was rising. And we've seen times when treasury yields were falling and gold was rising. And the common denominator throughout all of that has been that gold has been rising. Even when, what has been typically and commonly believed to be strong headwinds for gold have been arrayed against it, it has still managed to rise, and sometimes very strongly in the face of those headwinds. So generally speaking, I think we've been seeing strong money, smart money around the world increasing allocations to gold for a number of reasons. And I think one of the biggest ones is the debt situation in the U.S. and the repercussions of that for the purchasing power of the dollar. In similar situations in developed markets around the world where debt loads after 45 years of ever easier money, debt loads are too great to be maintained and serviced at current interest rate levels. And the amount of money sloshing around the world is inflationary. So you have that general unease that's been elevating the gold, supporting gold. Unfortunately, the buyers of gold, that the entities that are buying gold for those reasons, aren't yet looking to get torque on those investments through mining stocks. They typically don't buy mining stocks. Asian investors don't buy mining stocks. Central banks don't buy mining stocks. So that's why they've generally lagged. Since about the second half of last year, about midsummer thereabouts, we've seen Western speculators start to get involved in the market and start to buy mining stocks. And that's helped these levels, generally speaking, and we have seen the mining stocks leverage gold. But what's happened, so that's a general, the background story that we've seen over the last year. But in recent days, what has powered this latest rally, this latest surge to all-time highs and well beyond $2,800 has been, frankly, tariffs. And the uncertainty that puts in the markets, the potential that creates for a recession in the U.S., which would then lead to the Fed easing again, and the potential that would lead for higher inflationary pressures in the U.S. and general uncertainty. But that has been the fuel behind this latest rally. but it's also, I believe, the biggest risk for gold that we've seen in quite a while.
I think the common misconception out there is that gold's really only an inflation hedge, but actually, if you study financial history, and I know you've covered this in your newsletter over the years, Brien, but in deflations in the U.S. during the Great Depression, 1929, before FDR devalued the dollar against gold, and there was bankruptcy risk, because deflation normally means, for a society with a lot of credit, normally means a lot of bankruptcies. Gold is a counterparty-free hedge, because if you own physical gold, you don't have a lot of counterparty risk with stocks or bonds or other types of asset class investments. Also, a currency instability hedge. Gold is actually a very good currency instability hedge, because as the dollar has held up on a relative basis, the dollar index has rallied substantially with Trump winning the election and coming into the White House, putting on tariffs. You're seeing what currency weaknesses in Canada, Mexico. You had currency weaknesses throughout 2024 for a lot of Asian currencies with the Japanese yen, the Korean won. So all these other currencies, that has created demand for physical gold in those other countries. And do you think that that's the main demand driver the last 12 to 18 months is retail investment demand that has surprised the market in those other countries with currency weakness?
Yeah, in other currencies to some degree. Gold, the only reason to buy gold and the only factor that drives gold over the longer term is concern over the future purchasing power of your currencies. In the Depression with FDR, gold was money. The gold was on par with the dollar. So when the dollar was gaining that purchasing power in a deflation, then gold was gaining purchasing power as well. So that kind of made sense. These days, if there's any concern, I mean, somebody is always concerned to some degree about what their dollar or their home currency is going to buy next year or the next few years. But when they really get concerned, then they start acting and start buying gold. And that's really where we are right now. I also believe that rising treasury yields are a bit of a safe haven play, because some investors, usually falling under the category of bond vigilantes, are demanding higher returns in recognition of the greater risk that they see ahead. Also, the market, or smart investors, recognize that there's an absolute spike in the amount of treasuries that have to be rolled over this year. Nearly $10 trillion worth of treasury debt needs to be rolled over at higher interest rates. That's why I believe the Fed was so desperate to lower rates in September when it started off with a surprising half-point cut. They see this tsunami of debt resets coming down the pipe, and are desperately trying to get interest rates lower. In the meantime, at least on the long end of the curve, the bond vigilantes also see that tsunami of debt resets. They see that amount of new issuance that has to be flooded onto the market, and they're demanding much higher returns, much higher yields for Treasury securities. It's really is a desperate situation for the Fed, and I think an intractable situation for the new administration as well.
Yeah, I agree. It's a no-win scenario here, because if they start cutting government spending, and I would love to see government spending cut, then that's going to probably hurt the GDP numbers. I mean, there's no good scenarios here with the amount of DC spending at this point. I'm just tired of all the waste, fraud, corruption, and abuse, and the economic propaganda, spin, and lies. Now, you brought up deflation here with gold. FDR allowed deflation, they allowed the policymakers in Washington, D.C., not just FDR. They allowed deflation for about 4 years, from like October 1929 to about 1933. The gold price there, if you bought physical gold, you didn't have counterparty risk. But then all the Keynesians, the central planners, they didn't allow deflation for a very long period of time. They tried all these different things with deficit spending, insane government spending. They even, at one point, things got so desperate, FDR devalued the dollar against gold. Do you think if there is deflation that the policymakers will not allow it for very long?
Yeah, one of the earliest lessons I learned in this business, and learned from some of the greats in this business, was that central bankers, learn from a very early age, at their mother's breasts practically, to abhor deflation. they will do anything to prevent deflation. So, if there's a whiff of deflation, they will open up the floodgates of monetary liquidity. That's primarily why they have that 2% inflation goal, just to give them a little bit of a buffer, some breathing room before you actually get into deflation, in case there's some, they can make some policy mistakes and still not slide backward into deflation. Whether it's, accurate or not, or justifiable or not, they will do anything to avoid deflation. And so they will, without hesitation, ease money and return to monetary easing. And as we've seen, these things are usually in reaction to some crisis, a crisis or a bubble bursting that they have created. So we have these continual cycles of a crisis that they've created, like the 2008 great financial crisis, the COVID shutdown, et cetera, that maybe wasn't created by a central bank, but they were already quantitatively easing before COVID hit. So every time this happens, they have to have a reaction or a policy reaction that is much greater than anything they've done before to get the same effect on these markets, because the markets and investors have grown tolerant of this monetary adrenaline, and the dosages each time in each instance has to be much greater to get the same effect.
Well, also the tax receipts for the U.S. federal government for capital gains taxes and property taxes and those types of things at different levels of government, they are so reliant on high asset prices. The economy has been financialized the last couple decades, so reliant on the S&P 500, the stock market continually rising, and home prices continually rising. That's been an increasing percentage of the tax receipts that are taken in D.C. So it's in the government's incentive. They called it the wealth effect. Austrian school economists out there will call it the Cantillon effect. I think that's far more accurate. I think really, Brian, the last 3 years since the Russia sanctions, these other governments and central banks like China, Japan, especially outside the G7 too, they've just decided that there's a math problem, like you said, with the treasury market coming. They didn't know exactly when, and they decided, if they piss off DC, that they did not want to be large buyers of U.S. Treasuries, so they've been like diversifying into gold instead. I think the play has been like not buying Treasuries for these central banks when they have foreign exchange reserves, and they've just been slowly accumulating more gold tonnage each month.
That is exactly correct. I mean, the extreme example is Russia, that sold all of its Treasuries well in advance of the invasion of Ukraine, and exchanged those largely for gold. Other examples are China, that the great work by Jan Nieuwenhuis has shown that China's been buying all along, even though they've stated that they haven't, or haven't acknowledged that they have. Central banks are trying to gain in some measure of protection against the weaponization of the dollar. Not that they think that they're going to be the next target, but they don't want to expose themselves to that risk and maintain some level of independence. So that's that is deep, or has been, the main driver of the gold price for at least the first half of this bull market, and it still remains a very strong underpinning behind this bull market. We were very fortunate because Western investors are waiting for the Fed pivot before they started to invest in gold, or until the point where they saw that the pivot was coming and they could start buying in advance of it. But the gold price added about $300 before the Fed pivot, and therefore the Western investors coming in, they had to pay a much higher price to join the party. And to some degree, they've been willing to pay it because the trend for gold has been so reliably up. We've gotten those wiggles and those corrections. The correction after Trump's election was really the first and only severe correction in this new gold bull market. And we've bounced back from that with a vengeance at this point.
So I want to transition now to your analysis of gold stocks versus the gold price. I look at the gold price right now, and other people are also seeing this discrepancy. And I look at the gold miners ETF. The most common one that's most liquid that people trade is the GDX, the VanEck Gold Miners ETF. That one's currently at $40 per share of the gold miners ETF. That's a basket of the gold mining stocks like Barrick Gold, Newmont Mining, Agnico Eagle, maybe some Franco Nevada, and a few others mixed into there. That is way below the 2011 highs at, I think, like $64, $65. Why do you think that there's a huge discrepancy for some of these producing gold miners that have profit margins and free cash flow at the current gold prices? Why do you think the discrepancy between the gold price and the valuation for some of these miners could be up to 50% in some cases?
Yeah, we need Western investors to buy these stocks. We need Western investment funds and hedge funds and these speculators to buy the miners to get some torque on the gold price. The reason we haven't so far is, as mentioned, because central banks and Chinese citizens don't buy Western gold stocks. So that negated the performance of the gold stocks, at least for the early stages of this bull market. From the Western investor standpoint, there's just so many other ways to speculate these days. You have AI, you have Bitcoin, even in gold, you have the 2x ETFs, nugget and dust that you can do to get used to gain leverage to the gold price and even to mining stocks. So the result is that we just haven't had a large amount of money working its way down the food chain, trying to find ever greater leverage to the gold price, and getting into the intermediate producers, getting into the developers, and even the explorers, like we would have seen in previous bull markets. I think it's going to happen, though. I mean, you can't have this kind of a steady performance in the metals themselves without eventually getting those speculators moving into the market. And there have been anecdotal instances, anecdotal evidence that this is happening. We just haven't seen it to the kind of degree that we would have expected for now. We've seen the mining stocks, even the major indices, leverage the gold moves typically and often, but just not as much as we would have expected.
Yeah, I think to close the gap, if you're a producing gold miner, say you're an Agnico Eagle or a Lundin Gold or Alamos Gold, and you have good profit margins, low cost, free cash flow right now, you have some options out there because of the cash flow coming in with the free cash flow. You can either increase the base dividend, you can announce a variable dividend maybe, depending upon the gold price. You can go and buy back your shares. So if you think that your stock is really cheap, I think that shows a lot if the insider buying, like direct insider buying, goes and buys shares, or they announce a huge buyback program if it can be justified on a valuation metric with the free cash flow. And then the other one is acquisitions, Brien. Are we going to see some mergers and acquisitions if the gold price stays at these levels and you have some of those three companies with that much free cash flow? Do you think they're just going to hold the cash, or are they going to go and buy assets?
Well, I think a number of them will go and buy assets, but what we've seen so far has been more mergers of equals or near equals, like Newmont and Newcrest and the like. And that really doesn't do mining investors any favors, because it removes, or at least the junior mining investors, any favors, because it just removes yet another potential buyer for projects, for junior projects from the market. I think one of the areas of real opportunity are in the asset divestiture aspect of these mergers. We've seen that with Newmont as they divest some of their assets and some of the Newcrest assets and try to rationalize that portfolio that they've amalgamated. We saw a similar situation back in the early 2000s when the gold price was mired at all-time lows or long-term lows. And a lot of these majors were throwing out the baby with the bathwater. They were getting rid of, in those cases primarily, great exploration projects and discoveries. That's how we had Northern Dynasty. That's how we had Nova Gold, and a number of other companies just emerged by picking up these assets that were being discarded by the majors. We're starting to see some of that today.
Yeah, I think one of the things that listeners should pay attention to are some of these press releases with like Franco-Nevada, the larger royalty companies, or an Agnico Eagle, or one of the producing mid-tier gold miners like a Lundin Gold or Alamos Gold. If they're going and making investments into one of those juniors for like a drill program. So that means then that they think that there could be something really good there. We've seen this pay off in the past, for Goldfields and Osisko Mining with the Windfall project.
Yeah, they'll try to get a toehold in if they make an equity investment for an eventual purchase. So it is a good sign. They do gain an advantage by making a 9.9% or even up to 19.9% equity investment in a junior.
And for the royalty company, I mean, obviously they don't want to run the mining company, so they might buy a small royalty and fund a drill program. But then potentially, if there is a huge discovery there, they have it's called a right of first refusal into the contract for the junior, where they could potentially buy a larger stream and help finance a larger mine. So I think you will start to see more of that going forward. It's just right now, Brian. I mean, like, it's a no-brainer. Some of these companies, like the valuations are just disgustingly cheap. The mid-tier miners I mentioned, Sandstorm Gold, they just had the Greenstone Gold Stream come online, over a 15% free cash flow yield. They have all these assets under construction. Platreef Phase 2 is almost done in South Africa. It's going to be the world's largest platinum group mining operational mine when it comes online. And low cost too. So just like there's just stuff out there that's baby out with the bathwater, like you said, super cheap. It's just shocking that how cheap they are, given what we're almost at 2,900 gold right now, and the gold stocks are acting, what is it, 15 or 1,600 gold?
Yeah, and one of the opportunities in the market that I see, and something I don't think a lot of people realize, and for sure the market has yet to reprice, are the companies of really large resources, primarily gold resources in the ground. And that larger group contains a subset of the so-called optionality plays. The companies that were formed to buy large gold resources that were out of the money, weren't economic at then current gold prices, and trying to leverage the rise in gold prices that would suddenly make these projects economic and therefore much more valuable. At current prices, and really at gold prices $500 less than where we are now per ounce, all of these optionality plays became economic. Yet virtually none of them have seen much of a increase in their market value. I think that is a huge area of opportunity and it's not going to happen overnight, but over the next couple of years, I think you're going to see those projects re-rated by the market. There are other companies that don't even have economics on their projects, other resources that don't have economics in their projects, but they're very large resources. Banyan Gold is one of those that's in our portfolio that has a massive, really of strategic level resource, and you can look at that and know that it's going to be very economic at today's gold prices, and it's trading for about $6 an ounce in the ground. And history shows that those kinds of projects typically sell for $100 or $150 an ounce or much more. So at $6 an ounce, you're looking at a project that, if we're in just a normal gold bull market, will sell for 20 times that metric.
I mean, with the interest rates where they are still on the U.S. Treasury yield curve, the 10 years Treasury, and then the cost of capital for a lot of these smaller producers or a junior miner that's planning on building its first mine, I mean, the cost of capital is so high, it's not economic for them to necessarily go and raise the capital all on their own, or they have to basically gamble the whole company with equity dilution, reverse stock splits, and enormous amounts of debt on the one mine. It makes more sense for them to have a joint venture partner here to reduce some of the risk. So they have a mid-tier or a senior gold miner that's helping fund some of this stuff.
Yeah, if they want to do a joint venture, and that would be for a discovery play, but for a company that already has a significant resource delineated, they can sit tight and wait for the bids to come and hopefully get some competitive bids.
Oh, so you think that's what's happening now that some of these juniors are turning down offers right now because the valuation isn't good enough. So the share price is depressed, but they are getting some bids. It's just not good enough for them to do a deal yet.
Well, I really haven't heard of anything like that. It would not surprise me if they push some companies off at current valuations. Um, but I have not heard of that happening as of yet. Again, wouldn't surprise me, but certainly nothing of that sort has been in the public realm. But I have not heard any whispers of that either.
Do you think with Malay in office now and the policy changes he's making, I think there's a new tax break for the next couple years for large mining investments. I think it's 500 million or more capital committed in the next 2 or 3 years. That if a project starts, there's some type of tax break. Do you think that Argentina is now a very good place for mining companies to start building mines?
Yeah, geologically, it's always been one of the better places in the world. And I think more so for local support and governmental support and permitting support are more important than necessarily the tax breaks. I'm looking at the U.S. as being one of the preeminent regimes in the world for mining exploration and develop and production over the next couple of years at least. I think companies really need to look at this as a 2 year window where they need to rush in and try and get as far as they can before the midterm elections in the U.S. And get as much done while they still have that momentum.
That's interesting. I mean, there's like Rick Rolls talked about this. I can't remember the junior, but there's like a really good copper and gold project in Arizona next to producing mines that the
Mm-hmm.
environmentalists have been blocking with permitting for many, many years. So we'll see
Yeah, the
if that one.
resolution mine, it is a massive project, and it's just criminal that it's taken, a dozen years and it still hasn't gotten its permit.
What's the name of the company?
The discovery is a resolution resource, a mine
But
discovery.
Argentina's had some amazing discoveries with copper and gold in the last couple of years with the Jose Maria area deposit there with Lundin Mining and some of the other companies going in there. I mean, it looks like there's a bunch of discoveries there in Argentina. And then you have the Mara project, which is a base metal one. There's a bunch. And then there's a ton of silver ones with Abra Silver, and hopefully, fingers crossed that the La Navidad Pan American Silver will be able to restart that project soon.
Yeah, but consider too that if you're looking at a gold project, probably 4 years to production would be lightning fast speed. You're probably looking at 5 to 6 for a decent sized project. If you're talking copper, you're talking really 12 to 15 years would be optimistic, and in some cases 20 years to go from to production of a known deposit. From discovery to production, you're looking at 20 to 25 years. So the the advantage that the copper market offers analysts is that they can go out and look at all of the known copper deposits out there and very reliably predict what new production is even possible over a fairly long-term time frame. And what you see from that standpoint in copper, having that kind of vision on new supplies, is that it will be impossible to supply the market the demand curve that we see ahead for copper. And we will have to have much higher prices to spur not only more rapid production response, but also recycling and scrap response to meet the demands of the market. So copper is, even though you can see these big projects and discoveries, they are not going to have any impact on the supply curve for many years into the future.
I want to get your thoughts on Mexico because, 9, 10 months ago, with the elections in Mexico, people are panicking about open pit mining, either not getting permitting or potentially a ban. And then those worries kind of calmed down a little bit. Are you still worried that Mexico will become like very anti-mining and the permitting process will be shut down or slowed by years?
No, I'm not especially worried or any more worried, probably a little more encouraged. I talked to dozens of company execs with projects in Mexico on my recent trip to Vancouver. And, really without exception, they were very encouraged by what they're seeing in Mexico. So, good number of them said that there's going to be no problems going forward. But then again, we have to recognize that all of these people have projects in Mexico, and to some degree, they're talking their own book. Um, I tend to look at the contribution that mining makes to the Mexican economy and open pit mining as well, and don't really see a way that they can completely shut it down. So I think that the future is brighter for Mexican mining. For one reason, it can't get much worse. Uh, so I do believe it's going to be better going forward, and I don't believe that they can completely shut down mining. I think Scheinbaum's very quick reaction to the Trump's tariffs shows that she's a bit more practical than AMLO, perhaps, and I think that's encouraging.
Well, I think with Mexico, a lot of the low-hanging fruit the last 15 or 20 years has been picked. So all the high-grade, low-cost projects have already been developed. And so some of the ones that could be developed now, like the silver deposits, like Pizzeria and some of the other ones, I mean, those need $35, $40 an ounce silver. They need higher copper prices. So they're not as good. They're more marginal. So for a mining company to develop some of those larger projects in Mexico, we're going to need sustainably higher metals prices.
Well, silver is a bit of a different story too, and especially in Mexico. A lot of Mexican production comes from high grade, vein hosted, structurally controlled mines, smaller scale mines, where the veins just go on forever. And, the traditional local Mexican mining operations never drilled off resources. They just drilled off what they would need to produce over the next few months, or didn't drill off anything at all and just followed the vein. And the consistency and continuity of these veins are remarkable. And all of that little small scale production adds up, uh, in Mexico specifically. And it's not as hard in that kind of scenario in terms of time or money to start up a new mine. And there are a number of mines that can start up in silver, projects that could be started up fairly rapidly in Mexico. So I think we could see a supply response in silver, but we also have a number of other demand factors for silver that are growing right now. And we have a structural deficit over the last 4 or 5 years. So a long way of saying I like silver, but I think the supply component of silver can be ramped up a little more quickly than obviously copper.
That's an interesting point there with Mexican silver production because, like, the obvious example is Silvercrest, right? Their high grade mine was not super large, but then you have these massive projects that Fresnillo likes to develop, and then also the Mag Silver project, Juanicipio. I mean, that's like a once in a generation type of project because I think what the average grades were 400 grams per ton silver, something like that. And the mine life had over 30 years of reserves.
Yeah, and 70% of global silver production is as a byproduct. So what that means is you don't have the potential for a rapid fall off in production. But there are a number of primary silver mines that can be started up. I just think that demand curve for silver is still going to dwarf the supply response, and really that goes for metals across the board. That goes for base metals. That goes for precious metals. We're really in a unique and exciting period in human history and investing history where we have two megatrends that are occurring side by side, one for base metals and one for monetary metals, and really just completely independent of each other.
Are you talking about for base metals? Are you talking about copper and for what data centers and artificial intelligence and electric vehicles and things?
Yeah, data centers is one thing, but the electrification of transportation and the electrification of much of the developing world, that was the primary driver, and now we have AI thrown on top of that. And if you just look at the base case, current technologies, current demand growth for copper, for instance, It's already very steep and uh, unaddressable by current supply projections. But then when you add all of these other factors, when you add electric vehicles, when you add the rebuilding, if not, duplication of the global electric grid to handle um, uh, electric automobiles and the electric demands in the developing world, and then you add on the AI centers. I think copper in particular is the one energy metal that you can't get around it. You can't innovate around copper. You will always need copper to transport the electricity. You'll need it in the AI and the data centers, and you'll need it for the copper windings in any sort of electric motor. You simply can't get around copper. So that's why
Also, hopefully the electrical grid gets upgraded. I mean, I keep saying this like every year, like hopefully like these infrastructure bills, hopefully they will upgrade the electrical grid. It looks like they're going to have to if they're going to build out these data centers.
they will, but it's going to be done in a haphazard catch as catch can fashion. I don't think you're going to see any kind of a you know integrated effort across the U.S. or across most countries to address that.
So, since you were just in Vancouver for the Vancouver Resource Investment Conference, I want to get your thoughts on which countries are the mining companies seeing as better now for investing in potentially new drilling activities, new mines. Are there any countries that you think where the political climate, besides Argentina, I guess, where the political climate has changed and mining companies are now starting to get more bullish on where they're going to start making investments into drill programs and building mines?
Well, I think the mining frontier that benefits from all of that really right now is the U.S. I think there's excitement there. I mean, I don't see anywhere where there's a rush to get into any particular region or geography or closeology around the world, but there is some excitement on the permitting front in the U.S. and having it become much easier to develop projects. The Ambler Access Road uh, in uh, in Alaska is probably the premier example of a new region or a region that's going to be opened up because some the environmental decisions of the previous administration will be reversed. There's really only two plays up there right now that benefit from that. But those, and it's going to be perhaps the better part of this year before we see the possibility of those environmental decisions being reversed. So that's one play one area that's already benefited. But once that road is approved, I think you're going to see a lot more action in the Ambler mining district in Alaska.
So by road, you mean like infrastructure investments, how they have to put in like roads and power, like electrical utility or a grid, or a power station or something like that?
Yeah, more so road access because they have to get the ore out of there. It's landlocked, and they need the road to be able to transport production from Trilogy's projects up there and some other mining projects.
Oh, okay. Because like there's, I don't know if it's up there. I'm not familiar with all the mine, the map for Alaska. There was what the Northern Alaska, the Pebble project, and environmentalists have been blocking that one for 20, 25 years. That has an absolutely insane amount of copper, gold, and silver. But I think what it says, it's a habitat for the Pacific salmon. So they've been blocking that.
Yeah, it's the concern is over the drainage for the part of the project is on a watershed for a salmon fishery, important salmon fishery, and it is a massive project. I've always been, well, not always, but have been doubtful that we'll ever see that project developed in recent years. I think that there's a good chance it'll actually um, get developed at this point if we have successive Republican administrations in Washington. It'll take two or three administrations to get that thing well on the road. I do believe there'll have to be some re-engineering of the project to try and find some kind of a compromise.
Yeah, I wouldn't hold my breath. I mean, like if Congress flips in the next midterm elections or the next president 4 years from now, and the one after that 8 years from now, if it goes back to Democrat, I mean, they're going to, any progress on that project is probably going to get blocked. The environmentalist lawyers, that's like one of the main projects that they've been fighting for 20, 25 years.
Well, the key aspect is that the law was broken to stop the project, to halt the project. So that there are, procedures and laws and permitting procedures in place, and that project was following all of those. But the decision by the Obama and Biden administration, EPAs, were just administrative decisions that violated the law and short-circuited the process. That's been my big beef with it. I'm personally not even sure that the project should be developed, but it's been a moot point because it hasn't had the chance to go fully through the process.
Well, unfortunately, Brien, living in Washington, D.C. for almost 25 years, I mean, a lot of the bureaucrats in the government agency, politicians, they don't like following the law. So they're like, if we're breaking the law, we'll just change the law, or we'll have our friends in the Department of Justice, our friends there that are lawyers for prosecutors or whatever, not charge us.
Well, and from a presidential administration standpoint, they can violate the law and just have it settled in the courts. But by the time it wins its way through the courts, then the effect of whatever they wanted to do would have been accomplished. And usually that effect is simply to buy votes.
Now, as we wrap up here, since you have a time constraint at the top of the hour, I want to get your thoughts on the prospect generators like an EMX or some of the others, EMX Royalty that does a hybrid model of royalty company and prospect generation, and the royalty and streaming companies, the senior ones and the mid tiers. Do you think that they're extremely well positioned in the current gold price environment to go do deals and raise dividends?
Yeah, they are. Though the best ones are. EMX has always been among the best. David Cole and his team have been some of the most far-sighted operators in the industry, and they have opened up new frontiers and gained projects, in project positions, and then optioned them out around the world. And very far-sighted, very insightful operators. Another great company that I think is one of the best, if not the best managed prospect generators in the business is Kenorland Minerals. And Zach Flood has just done an amazing job there. They're actually making money from their portfolio of projects and have, more lottery tickets out there, many more lottery tickets out there than any comparable company of their market cap. So there's some great companies out there. I've never been a big believer in the prospect generator business model because so many companies look at it more as a religion than a business model. I think there are exceptions. There are projects that kind of demand that a company take them on to some degree by themselves to preserve that upside and build that value. So you can't look at it or shouldn't look at it as a religion. You need to look at it as a business model. And when you come across an exception or exceptional project, you need to be willing to violate that model a bit to really build value more rapidly and to a greater degree.
And shockingly, there's good value for a lot of the royalty companies across the board right now. One of the few royalty companies that has outperformed the last 12 to 18 months is the Australian one. They're ultra small cap. I was writing about them for my patrons 18 months ago called Vox Royalty, and they actually get the Australian dollar gold price. So that's been one of the beneficiaries. They have royalties on mines in Australia, and so they've been benefiting from that much higher Australian gold price.
Yeah, they focused a lot on Australia, and that's been a recommendation in our newsletter for a while, and kind of a core holding for me personally as well. It's a very well run company, and you look at these companies, and when we first started recommending Vox, I guess about 3 or 4 years ago, a number of the projects that they got or had or acquired were earlier stage and not close to production. And now you see that portfolio maturing and a lot of these projects starting to either get near to production or actually into production, and revenues are actually growing at a very rapid pace. for a lot of these companies and for Vox in particular.
So I think if I could summarize which countries for our listeners should look at for mining companies where they're making investments, the two new ones, shockingly, are going to be the U.S., which has been anti-mining, or like the permitting process has been ridiculously difficult in many states for many years, for decades now, due to the bureaucracy. And then you have the federal bureaucracy and the state one in states like California or others that have like very strict environmental standards, because California is super anti-mining in most cases. And then the other one is Argentina, because there's a new tax law, I think, with a $500 million or more mining investment, I think through something in 2026.
Yeah, those are certainly areas to watch. I would agree.
Well, I want to thank you so much for your time today. Please tell my listeners more about your gold newsletter and then about the New Orleans Investment Conference.
Yeah, Gold Newsletter. You mentioned that it's the oldest mining and metals newsletter out there. I believe it's very likely the oldest investment newsletter in existence today. We're in our 54th year, and I don't know of any older than that. And we have a long and rich heritage, a legacy of finding the best investments for investors in resources across the board, but particularly gold and silver over those decades. So you can go to goldnewsletter.com to learn all about it and what we do.
Oh, your
And
newsletter started before Howard Ruff and Richard Russell?
I don't believe Richard Russell. Richard's letter went beyond ours, but we were out there before Howard Ruff. Yeah, it was started really on August 15th, 1971, when Jim Blanchard, who founded everything that we do today, our old organization, heard the announcements by Richard Nixon that he was closing the gold window, severing the last connection between the dollar and gold. And Jim knew that this would usher in an age of much higher inflation, and obviously that happened. He started Gold Newsletter as his primary tool to fight, to lobby for the legalization of gold once again for American citizens.
I think
And
Don
so,
McIlvaney started his newsletter around then too. He also helped get gold legalized for American citizens as well. I also used to work at a larger paid newsletter company. I think it was trying to remember the guy's name offhand. I don't have it written down. It was Capital Information Group Investment Daily in the 70s. They hired Doug Casey when he was a young man. It was a libertarian Austrian school gold newsletter. I think it was Bob Gephardt. It was they had like old copies of the printed archives that I was looking through, like, and it was like all libertarian Austrian school economics talk about inflation, very similar to the history of yours.
yeah, Kephart was one of the early newsletter publishing organizations out there. And, there was a real, very prolific and hard money newsletter world out there. It was an alternative media that I think is somewhat similar to what we see today through what was financial Twitter, and now I guess it's financial X, where you see a lot of great thinkers out there who are kind of rising to the fore to explain the extraordinary times that we're in. And a lot of those people who are really the leading lights today are featured every year at our New Orleans Investment Conference. That conference was started by Jim Blanchard in 1974 when he was successful. He and his comrade or colleagues in the hard money industry were successful in getting gold legalized. He decided to have an investment conference to teach Americans how to invest in gold. So he had the first one in 1974, and we just celebrated our 50th anniversary of that event last fall. This year's event will be November 2nd to 5th, and will feature again a lot of these leading lights in the alternative financial media today. And I urge people to go to neworleansconference.com to learn more about that event and how our roster of speakers for this year's event will be built up over the coming months.
And you got some of the best food in the world in New Orleans. I like blackened chicken, blackened shrimp, and jambalaya.
We have it all. In fact, you can come to our conference. I wouldn't advise it. I would advise you to sample the great restaurants in New Orleans, but you could come to our event and never have to pay for a meal during your entire stay. We do a great job of feeding our attendees and bringing the best of New Orleans inside our event.